Hey investors, welcome back to our channel Markets Analyzers. In this video, we will talk about financial derivatives. There are four types of financial derivatives, which are futures, options, swaps, and forwards. Third and fourth, swaps and forwards are not used in the financial markets, so we are not going to talk about them. We will only use futures and options in stock markets, and we will try to learn them. First, in this video, I will explain about futures, and in the upcoming videos, I will talk about options. Both futures and options are financial derivatives. A financial derivative is a contract whose value is derived from the performance of an underlying asset. A derivative derives its value from an underlying asset. For example, consider your name as a derivative. Your name should derive its value from an underlying asset. Your body should be an underlying asset. Hope you got what I am trying to tell you. I will give another simple example. Let's say our channel name Markets Analyzers is a derivative. Our channel name is a derivative. The name is deriving its value from the content in the channel. So friends, try to watch the content in the channel. If you think the content is good, please subscribe to our channel and like the video. Coming back to the video, so a derivative is linked with an underlying asset. Now let's talk about futures. What are futures? Think of futures as a promise between two people to do something in the future. Imagine you are a huge fan of mangoes. You like mangoes so much. But you know that mangoes are expensive in the winter and cheaper in the summer. Because in summer the harvest is huge, whereas in the winter we will mostly get them from other countries. So we make a deal with a shop owner in the summer to buy mangoes from him in December at 100 rupees per kg, no matter what the price in the winter is. This agreement is like a future contract. How do they work? It's like a promise for the future. A future contract is essentially a promise between two parties. They agree to buy or sell something like oil, wheat, or even mangoes at a set price on a specific future date. These contracts are traded on exchanges like NSE, BSE, and MCX, and the details like quantity, quality, and delivery date are all standardized. This makes it easier for people to trade them. Let me give you an example on how future contract works. Imagine you own a factory that uses a lot of steel. You worried that steel prices might go up in the next 6 months, which would increase your cost. Your raw material is steel. If steel prices goes up, you will need to spend more money to buy the steel. To protect yourself, you enter into a future contract to buy steel at 50,000 per ton in 6 months. In this way, even if price of steel goes up to 60,000 per ton or 70,000 per ton or even 1 lakh per ton, you will still pay only 50,000 per ton. On the other hand, a steel supplier might agree to sell you steel at 50,000 per ton to ensure they won't have to sell it at a lower price if the market price drops. I hope you understood what futures are and how they work. A future contract is a promise between two parties to buy or sell something at a set price on a specific future date. The future contracts are traded on stock exchange like NSE and BSE. Now comes the important question. Why should we use futures? Futures are mainly used for two purposes, hedging and speculation. First, let's talk about hedging. Hedging is a risk management technique used to minimize or eliminate the uncertainty associated with an investment. When someone buys a future contract, they typically believe that the price of the underlying asset, the asset could be gold, oil, wheat, whatever it could be, will increase in the future. They want to lock in the current lower price so they can profit later when price rise. This strategy is often used by both traders looking to make a profit and by businesses that need to secure their prices for future purchases. Let me give you an example. Let's say you own a gold shop and you believe that the price of gold is going to increase significantly over the next few months due to economic uncertainty. And it could be due to any reasons. You think gold price is going to increase. Currently, gold price is at 50,000 per 10 grams. You decided to buy a future contract at this price, locking in your purchase. If in 3 months, the price of gold rises to 55,000, let's say, per 10 grams, you made a smart move. You can either receive the gold, it means you can buy the gold at the lower price, 50,000, as agreed in the contract, and sell it at a higher current market price, making a profit. Or else taking physical delivery of gold itself rather than taking profits at 50,000 rupees. So you're taking gold delivery at 50,000 rupees. Even though the gold prices are now at 55,000, you still get them at 50,000 rupees. In this case, your view as a buyer is that the prices will rise. And by buying a future, you protect yourself from paying a higher price later. This is the gold buyer's point of view. When you buy a future contract of any commodity or anything, that's what your view is. Okay then, why would someone sell a future? On the other hand, when someone sells a future contract, they typically believe that the price of the underlying asset will either decrease or remain stable. Sellers are often producers or holders of the asset who want to secure a guaranteed price to protect themselves from potential losses due to price drops. For example, imagine you are a gold miner. It means you produce gold and you are worried that the price of the gold might fall in the coming months due to change in global economic situation. Currently, gold is priced at 50,000 per 10 grams. It's for example only. To protect your profits, you decided to sell a future contract, agreeing to deliver gold in 3 months at the current price. If after 3 months, the price of gold drops to 45,000 per 10 grams, you have protected yourself. You can still sell your gold at 50,000 per 10 grams as per the future contract, rather than taking a loss by selling it at lower market price. In this scenario, your view as a seller is that the prices might fall or that you want to lock in a certain price to ensure profitability and stability, regardless of whatever happens in the market. I will repeat once again. Buyers of futures believe that the prices will rise and want to lock in a lower price now to benefit later. There might be traders looking to make a profit or businesses securing future purchases at present cost. Sellers of future believes that the prices will fall or want to secure a price to avoid potential losses. They might be producers like farmers or miners who need to guarantee their income, or traders who believe prices will decline. In essence, buying and selling futures are strategies used to manage risk and capitalize on market expectations. The decision to buy or sell depends on the individual's view of where the prices are headed. Futures are used for speculation as well. It means trying to guess whether the underlying asset's price will rise or fall. Some people use futures to try and profit from price changes. They might not want the actual goods but are interested in making money from the price movement. Imagine you are a speculator who closely follows the gold market. You believe that due to upcoming economic instability, the price of gold, currently at 50,000 per 10 grams, will increase over the next 3 months. Based on your analysis, you decided to buy a future contract for gold at current price of 50,000 per 10 grams. With the contract set to expire in 3 months, you expect that the price of gold will rise due to factors like increased demand for safe haven assets or inflation concerns. For any reasons, you bought a gold future and you expect gold prices will increase. So there are two scenarios. In scenario 1, let's say your prediction is correct, and in 3 months, the price of gold rises to 55,000 per 10 grams. You can now sell the future contract for 55,000 per 10 grams. Your profit would be 5,000 per 10 grams, minus any trading costs. Since you never intended to actually take delivery of the gold, you simply profit from the price difference. You bought future for 50,000 and after 3 months, you are selling for 55,000. So 5,000 is your profit. In scenario 2, on the other hand, if price of the gold falls to 45,000 per 10 grams, you have misjudged the market. If you sell the future contract at this lower price, you would incur a loss of 5,000 per 10 grams. This risk is inherent in speculation, as price movements can be unpredictable. Mostly individuals like us will engage in future speculation because businesses and others will only buy and sell futures to protect their business. But we individuals buy and sell for quick gains. The primary motivation for speculating in futures is the potential to make a profit from anticipated changes in price. If you accurately predict these movements, profits can be significant. Future contracts typically require a small initial investment compared to the total value of the contract. This means that even a small movement in gold prices can lead to large profits or losses, making it an attractive option for speculators. In summary, gold futures speculation involves betting on future price changes in gold with the goal of buying low and selling high, or selling high and buying low. While it offers the potential for substantial profits, it also carries significant risk as the market may not move in the direction we expect. Now let's understand benefits and risk associated with futures buying and selling. First, let's speak about benefits. Hedging with futures helps to lock in prices and protect against adverse price moves, reducing financial risk. Hedging stabilizes cash flow and profit margins, providing more financial stability in uncertain market conditions for businesses. The other benefit is leverage. With futures, you can control a large amount of an asset with a smaller upfront investment, which can amplify potential gains. Basically, you are carrying a huge value asset with very little upfront margin. The other side of the coin, risk associated with futures buying and selling, are market movements. If market doesn't move in the direction you expect, you could lose a lot of money. While leverage can boost profits, it can also increase losses if things go wrong. Because if you buy a future, as I told, you can hold a very valuable asset by paying very little upfront margin. For example, 1 lakh product can be held by paying 20 or 25,000 upfront margin. What if within a single day, if the price moves 10% or 20% against your side? So you should be very, very careful. Now let me give you an example by including everything we have learned until now. Let's say you run a chocolate factory. You need a lot of cocoa beans. Cocoa beans are raw materials for making chocolates. Without cocoa beans, you cannot make a chocolate. But you are worried the price might rise because of bad harvest in cocoa producing countries. Cocoa is mainly produced in countries like Brazil, Ecuador, and Indonesia. cocoa harvest is bad in these areas you are thinking. So you decided to enter into a future contract to buy cocoa beans at 1000 per kg in 6 months. You are buying the future contract now, but you will get the product cocoa beans after 6 months at 1000 per kg. If in 6 months the price of cocoa beans rises to 1200 per kg or 1300 or 1500 or 2000, wherever the price goes, you made a smart move. You will still pay 1000 per kg, saving money. If the price drops below 1000 means you are stuck paying 1000 per kg, which means you end up paying more than the current market price. Until now, I explained everything with examples. Now let me show you how to buy and sell a future contract. I will also explain the doubts you will get along the way. This is the most important part in this video, so beginners try to focus. First, let me add HDFC Bank share. This is HDFC Bank share price. It is trading around 1632 rupees. Now let me add HDFC Bank futures. Why I have added 3 futures? Because any stock which has futures, it will have 3 different futures: near month expiry, next month expiry, and for monthly expiry. Right now we are in August, so August future is known as near monthly expiry. September future is known as next monthly expiry, and October monthly future is known as for monthly expiry. The current monthly expiry is called near, the next month is called next monthly expiry, and third following month is called for monthly expiry. Let me ask you a question. For example, let's say we are in January month. What will be the for monthly expiry? Tell the name of that month in comments. You learned that stocks have 3 different expiries, but on what date will the contract expire? The contract expires on last Thursday of every month. Now we are in August. The August monthly expiry contract will expire on last Thursday of August, which is 29th August. That's same for all months. The next contract, September contract, will expire on last Thursday of September. Last Thursday is the expiry day. Remember that. If Thursday markets are holiday means the expiry will happen the previous day, Wednesday. If Wednesday is also holiday means it will happen on Tuesday. And one more thing, the prices of futures are different from each other. The HDFC Bank share price is 1632 and August month future price is 1632. The next month September future price is 1641 and for month contract price is 1750. The difference in prices between near, next and for month future contracts is primarily due to the time to expiry. Near month, these contracts have the shortest time to expiry, typically within 30 days. So the price is closer to the spot price of the underlying asset. Underlying asset is HDFC Bank and spot price means it is the share price of HDFC Bank. This is the spot price. Always remember, spot price means underlying asset price. Next month, these contracts have a bit more time to expiry, usually around 60 days. The price is slightly higher due to additional time value. For month, these contracts have the longest time to expiry, often around 90 days. The price is highest among the 3 due to maximum time value. So longer the time to expiry, higher the price of the future because of time value and few other factors. Now let me show you how much money you should have to buy a future and how much profit and loss you will get if your future moves by 1 rupee. Let's discuss all this. If you try to buy near monthly expiry contract, which is August future contract of HDFC Bank, this is the price of the future, which is around 1632. In futures, you can only buy in lots. You cannot buy 1 or 2 quantity. You can only buy a lot. 1 lot is equal to 550 quantity, which is mentioned here. So to buy this 1 lot, you should have 1,57,635 rupees. Only if you have that amount in your trading account, your broker will allow you to trade. Now, let me tell you the value of this future. To get the worth of this future, multiply total quantity by current price. Total quantity is 550, current price is 1632. If you multiply both of them, we will get 8,97,600 rupees. Just now, I told you that you can buy a future if you have margin money of 1,57,635 rupees. Now I am telling you the future value is 8,97,600 rupees. What's the difference between these two? The broker is telling you, if you want to buy this future which is worth 8,97,000 rupees, give me just 1,57,000 rupees, I will allow you to buy. The broker is giving you the leverage to buy. Okay then, what about the profit and loss? For every 1 rupee change in future price, your profit or loss changes by 550 because 1 lot is equal to 550 quantity. If your future price changes by 10 points means your profit and loss changes by 5,500 rupees. If your buyer means the future price should increase, if your seller means the future price should fall. Now, before moving on to expiry scenario, let me once again remind you the definition of a future. The future is a financial derivative which derives its value from an underlying asset or stocks or index. Future contracts are an agreement between buyer and seller to buy something which they agreed at a set price on a specific future date. Remember, set price, it is the price we agreed while making the contract on a specific future date. set price, specific future date. Now let me explain all this with HDFC Bank future. So all these futures are deriving their value from an underlying asset. In this case, what is the underlying asset? It's obviously HDFC Bank share. These futures are getting their value from HDFC Bank spot price. I hope you understood this part. Next, I told a future contract or an agreement between buyer and seller to buy something which they agreed at a set price on a specific future date. Now, I am going to tell you what happens if you hold till expiry. Let's say, for example, person A bought this August monthly future at this price of 1632 rupees. If person A is buying means someone should be selling, right? So, let's say the seller is person B. Person A buyer, person B seller. So, person A and B made an agreement. According to this agreement, person A is telling to person B, I want HDFC Bank shares at 1632 rupees on the end of this month. I means on expiry day, last Thursday of this month. Seller is telling to the buyer, okay, I will give you HDFC Bank shares at 1632 rupees on the expiry day. So now person A is buyer, he wants HDFC Bank shares at 1632 rupees. Now as a future buyer, if you hold the contract until expiry day, you should take the shares from the seller. To take those shares, you should have 8,97,000 rupees because you bought one lot is equal to 550 quantity. 550 quantity multiplied by 1632 rupees, we get roughly around 8,97,000 rupees. On the expiry day, if HDFC Bank shares is trading at any price, it is now trading around 1632. Even if it reaches 1700 or 2000 or wherever it goes, according to your agreement, the seller of future will give you those shares at 1632 rupees only. You don't have to pay a single rupee extra. Now person B as a seller, he should have the shares of HDFC Bank to give them to the buyer if he stays in that agreement till the expiry day. We should have 550 quantity, one lot of HDFC Bank shares to give them to the buyer. What I told is, if you stay till expiry day, this criteria applies only if you stay till expiry day, remember. For person A, buyer, the price of underlying asset should rise. Only then he will gain. For person B, seller, the price of underlying asset should fall. Only then he will gain. I told you earlier that broker will only collect the margin amount. He won't collect full future value. Even for seller, the broker won't look whether he has the shares to give them to the buyer. But you can enter the trade. Only when we reach closer to the expiry, the broker will ask total money from the buyer and shares from the seller. If you don't have the money as a buyer or shares in your demat account as a seller, the broker will just automatically close the positions. You can move on to the next monthly contracts, and when next month future contracts comes close to expiry, you can move on to the next month. Only if you stay till expiry day, all this will apply to you. If you close the positions earlier itself means you can settle with your profit and loss. If you just buy today and sell within few days, then you don't have to keep the total future amount as a buyer or the shares as a seller. The profit or loss you get will be settled in cash. If you get profits, the amount will be credited in your trading account. If you lose the amount, it will be deleted from your trading account. Similar to stock futures, there are futures for indices as well, like Nifty 50, Bank Nifty, etc. The logics are all same for all the futures. It could be stocks or index like Nifty or Bank Nifty, or even commodities like crude oil, gold, silver, copper. Let me now show you a Nifty 50 future and explain some of the doubts you might get. This is Nifty 50 index. The value of the index is 24,541 as of today. The below are the futures of near, next and far monthly expiries. These futures derive their value from the underlying asset Nifty 50. If the underlying asset value increases, then the future value will also increase. If it falls, the future value will also fall. One lot is equal to 25 quantity. At once, you can buy only 25 quantity, not less than that. If you want to buy more than 25 means, you can buy 2 lots, which means 50 quantity, or 3 lots, which is 75 quantity. To know how much quantity comes under one lot, click on this icon in Zerodha. They will show you. Each and every stock and index will have different lot sizes. Don't think all the futures have same lot size. Similarly, to buy one lot of August future, the margin required is 68,800 rupees. Total value of future is future value multiplied by quantity. Future value is 24,598 multiplied by quantity 250. We will get 6,14,950 rupees. But broker is only asking you to pay 68,000 rupees. But you might get it out. In stocks, if I buy a stock future and hold till expiry, I will get stocks. What will I get in index? In index, the settlement will happen only in cash. So nothing to worry. Whatever profit or loss you gain will be settled in cash. You will get the cash, both for buyer and seller. So if you have any doubts, please comment below. All the indices and stocks in NSE are having last Thursday in the month as the expiry day. All the futures will have 3 expiries. Current monthly expiries called near month futures, followed by next month and 4-month contracts. In stocks, if you hold the future contract till expiry, you as a buyer should have the total future worth of amount in your account. Or as a seller, you should have stocks in your account, means in your trading account. In index, the settlement will happen only in cash. And most of the brokers will not allow you to stay in the contract till expiry. They will intimate you to move on to the next monthly expiry. Even the commodities will have the futures. They will also be similar to what we have spoken, but they have different expiry dates. There might be some little differences between stocks and commodities. If you want a detailed explanation, means do comment. I will do a separate video on the topic. I hope you understood everything. The only way you wouldn't have understood is by a very bad explanation. I think I have done a good job. Hope so. So friends, this is the video. If you found the content informative at any stage, please like the video and subscribe to our channel Markets Analyzers and share the video and the channel with your friends. So it would encourage us to do even better work. I will come back again with another interesting video. Until then, have a great time.